The same setup could look great one week and terrible the next. The same breakout could lead to a clean move one day and completely fail the next. The same market could feel easy one month and confusing the next. And for a long time, I thought the answer was a better setup, a better entry model, a better confirmation. Eventually, I realized I was trying to solve the wrong problem. I wasn't struggling because I needed a better setup. I was struggling because I didn't fully understand where price was operating. Most traders start their analysis by looking for entries. I did too. I jumped straight into setups, confirmations, and trade ideas. But the market doesn't care where you want to enter. It doesn't care about a setup. It doesn't care about your confirmation. Yet that's where most traders start their analysis. The question I should have been asking wasn't, where do I get in? It was, where is price? That sounds simple, maybe even obvious, but that shift changed the way I look at markets. Let me show you what I mean. When most traders open a chart, they're usually focused on what price is doing right now. The current candle, the current move, the current setup. But what I became more interested in was location. Where is price operating relative to important structure? Is it near the top of a range? Near the bottom? In the middle? Trading above an important reference? Trading below it? Because those locations create different expectations. And different expectations lead to different decisions. For example, imagine 3 charts. In this example, price is extended into the upper boundary. What do most traders do here? They look for continuation, breakouts, long setups, but ask a different question. What if this isn't expansion, but exhaustion? Now price is sitting in the middle. No clear edge, no obvious advantage. Yet traders still try to force a trade, even though the market hasn't really revealed much yet. Now price is at a lower boundary, support area, discount region, and now the same traders look for reversals. But again, nothing about the setup has changed. Only location has. So here's the question. Should we expect the same thing from all 3 situations? Probably not. The location itself is already providing information. And that's what I mean by context. Context isn't an entry. It's not a signal. It's not a setup. It's understanding where price is operating before looking for opportunities. Because location changes expectations, and expectations change decisions. The more I studied how price moves around ranges, around opens, around higher time frame levels, the less I cared about entries and predicting direction, and the more I cared about where price was in relation to everything else. Because when you understand location first, you stop forcing trades. You stop treating every setup the same. And you start making decisions based on context, not impulse. That's why context became the first step in my process. Not because it predicts the future, but because it gives me a framework for interpreting what I'm seeing. So next time you open a chart, don't start with, what can I trade here? Start with, where is price? Because that answer changes everything that comes after. And once you understand that, the next question becomes, how is price behaving around that location? That's where things get even more interesting.